If silver breaks above $35 with conviction, this is no longer just another commodity rally. At that point, we are not talking about a short-term bounce or a speculative squeeze. We are talking about a structural shift in how capital views risk, inflation, currency stability, and the broader monetary system. The difference between 34.80 and 35, the 20th of May, looks small on a chart, but in macro terms, it is the difference between hesitation and acceleration. Right now, silver is sitting at a crossroads. The $30 level was the first line in the sand. It represented the upper boundary of a multi-year consolidation range. For years, silver has oscillated between periods of excitement and disappointment. But 30 has consistently acted as resistance. Once price clears 30 and holds it on a weekly and monthly basis, the conversation changes from temporary rally to potential breakout. But $35 is something else entirely. 35 is where the market proves that this is not just gold dragging silver higher. It is where momentum traders, institutional allocators, and industrial buyers all start reacting at the same time. To understand why 35 matters so much, we need to step back and look at the structure of this market. Silver is not just a monetary metal. It is also an industrial input used in solar panels, electronics, electric vehicles, and advanced manufacturing. That dual role makes silver more volatile than gold. When fear rises, silver can lag because it is tied to economic activity. But when confidence builds around inflation, currency debasement, or supply constraints, silver can move dramatically faster than gold. The gold-to-silver ratio tells part of the story. Historically, that ratio has averaged somewhere between 50 and 60 over long stretches of time. In periods of stress, it has blown out to 80 or even 100, signaling silver underperformance relative to gold. When the ratio contracts, it signals silver outperformance. If silver pushes through 35 while gold remains firm, that ratio compresses further. That compression is often a signal that the market is shifting from defensive positioning into a more aggressive inflation hedge stance. In past cycles, when the ratio has fallen rapidly, silver has not just inched higher, it has accelerated. Now layer in inflation and Federal Reserve policy. Inflation has proven sticky. Even when headline numbers cool, structural pressures remain. Wage growth, supply chain realignment, geopolitical fragmentation, and persistent fiscal deficits all create a baseline of inflation risk that is higher than what we experienced in the decade following the global financial crisis. The Federal Reserve can talk about being data-dependent, but the reality is this. With government debt levels elevated, sustained high real interest rates are politically and economically difficult to maintain. If markets sense that the Fed is nearing the end of its tightening cycle, or worse, is preparing to ease in the face of slowing growth, the dollar tends to weaken, and when the dollar weakens, silver historically benefits. But it is not just about rate cuts, it is about real rates. Silver tends to respond strongly when real yields decline. That can happen because nominal rates fall, or because inflation expectations rise faster than rates. If investors begin to doubt that central banks can maintain price stability without triggering recession, capital flows shift toward hard assets. A break above 35 in silver could signal that the bond market is pricing in that doubt. Dollar strength is another critical variable. Over the past several years, the dollar has remained relatively strong compared to other major currencies. That strength has suppressed commodity prices in dollar terms. If the dollar begins to trend lower due to widening deficits, geopolitical shifts away from dollar-based trade, or coordinated policy easing, silver has room to expand. A decisive move above 35 would likely coincide with a period of dollar weakness or at least dollar stagnation. Then there is industrial demand. The global push toward renewable energy is silver-intensive. Solar panel manufacturing consumes large quantities of silver, and while manufacturers constantly seek ways to reduce silver content per unit, overall production growth has offset those efficiency gains. Electric vehicles and high-tech electronics add to that demand. At the same time, supply growth has not been explosive. Mining projects face regulatory hurdles, environmental constraints, and capital discipline from companies that remember the last commodity boom and bust cycle. Many silver deposits are produced as byproducts of other metals like copper and lead. That means supply is not always responsive to silver prices alone. If silver rises sharply, production does not instantly surge. This combination of constrained supply and steady industrial demand creates a tight market structure. If investment demand increases simultaneously, even modest inflows can have outsized price effects. Silver's market is smaller and less liquid than gold's. That means it does not take the same volume of capital to move it significantly. When price clears a major technical level like 35, systematic funds, algorithmic strategies, and momentum traders may all add exposure. That layering of demand can create rapid upside moves. So what happens if silver breaks 35? The bullish scenario is straightforward but powerful. A confirmed weekly and monthly close above 35 signals that the multi-year ceiling has been removed. In that environment, 40 becomes the next logical magnet. $40 is not just a round number. It is a psychological milestone. It represents a zone where past rallies have stalled. If silver reaches 40 with strong volume and sustained buying, then the market begins whispering about 50. $50 is a historic level associated with extreme cycles, both in the late 1970s and again in 2011. A move toward 50 would not be about short-term speculation. It would imply deep concern about monetary stability, sustained inflation, or a structural shift in global capital flows. In a true bullish scenario, gold would likely also be strong, perhaps making new highs. The gold-to-silver ratio would compress meaningfully. Real rates would be falling or at least expected to fall. The dollar would struggle, industrial demand would remain firm, and perhaps most importantly, retail participation would still be relatively low in the early stages. The strongest bull markets often begin quietly, driven by institutions reallocating portfolios, not by social media excitement. The neutral scenario is less dramatic but more common. Silver could break 35 intraday or even for a few sessions, triggering headlines and excitement only to fall back below that level. In this case, 35 acts as resistance again, confirming that the market is not ready for a sustained breakout. The price might oscillate between 30 and 35 for months, building a broader base. This would not invalidate the long-term thesis, but it would signal that macro conditions are not yet aligned. Perhaps the Fed remains restrictive longer than expected. Perhaps the dollar holds firm. Perhaps industrial demand softens due to global slowdown. In this scenario, patience becomes critical. Investors who chase the breakout without confirmation risk being shaken out. The bearish risk must also be taken seriously. If silver approaches 35 but fails repeatedly, forming lower highs, that pattern can attract short sellers. If at the same time inflation drops sharply, economic growth slows significantly, and the Federal Reserve maintains high real rates, silver could retrace toward 30 or even below it. A sustained break back under 30 after failing at 35 would send a clear message: the market is not pricing in a monetary crisis or inflation resurgence. Instead, it would suggest disinflation or deflationary pressures dominating. In such an environment, gold might hold up better than silver, and the gold-to-silver ratio would expand again. One of the biggest mistakes investors make in markets like this is assuming that price alone confirms narrative. They see silver approaching 35 and immediately conclude that a new era has begun. Smart money does not operate that way. Institutions watch confirmation signals. They look at weekly closes, volume patterns, positioning data, and macro correlations. They analyze whether the move is accompanied by rising open interest, declining real yields, and broad commodity strength. They do not chase every spike. They scale in, hedge, and maintain flexibility. Another common mistake is confusing volatility with direction. Silver is volatile by nature. 10% swings are not uncommon. That volatility can trap emotional traders. If silver spikes above 35 and then pulls back $2 in a week, retail investors may panic, assuming the move has failed. Meanwhile, larger players may view that pullback as a retest of support. The difference between emotional reaction and strategic positioning often determines long-term success. Around this point in the cycle, there is a critical turning point that many overlook. It is not just about inflation or interest rates. It is about liquidity. Global liquidity conditions, driven by central bank balance sheets, fiscal deficits, and credit creation, often precede commodity moves. If liquidity begins expanding again, even quietly, risk assets and hard assets can rise together. Silver thrives in environments where liquidity is abundant, but confidence in fiat currency erodes. A break above 35 that coincides with expanding liquidity would be far more significant than a breakout driven by short-term speculation. But here is the overlooked risk. If liquidity tightens unexpectedly due to a credit event, banking stress, or sudden policy error, silver can fall sharply even in a long-term bullish environment. In past crises, silver has initially sold off as investors liquidate positions to raise cash. Only later does it recover as monetary stimulus floods the system. That sequence can confuse investors who assume silver always rises during turmoil. The timing matters. This is why the $35 level must be evaluated in context. Is the breakout happening alongside falling real rates? Is the dollar weakening? Is gold confirming the move? Are industrial metals also strong, suggesting broad commodity momentum? Or is silver acting alone, driven by temporary enthusiasm? If we move beyond 35 and approach 40, the conversation intensifies. $40 would likely attract mainstream media coverage. At that point, retail participation increases. Exchange-traded fund inflows could accelerate. Mining equities would respond, often with leverage to the metal's price. But this is also where discipline becomes essential. Parabolic moves rarely sustain indefinitely. The smart approach is not to predict exact tops, but to manage risk, recognize extended conditions, and avoid overexposure. Conversely, if silver fails at 35 and returns to 30, that does not necessarily end the story. Consolidations can last longer than expected. Long-term bull markets often include multiple false starts. What matters is the higher timeframe structure. Are higher lows forming? Is the long-term trend intact? Is macro policy shifting gradually in favor of hard assets? Ultimately, $35 is not magic, it is symbolic. It represents a threshold where skepticism gives way to recognition. Below 30, silver is often dismissed. Between 30 and 35, it is debated. Above 35 with conviction, it commands attention. And above 40, it demands respect. Preparation is not panic, it is awareness. If silver approaches 35, investors should already know their plan. Will they add on confirmation? Will they wait for a retest? Will they hedge? Will they reduce exposure if the breakout fails? Decisions made in advance are almost always better than decisions made in the heat of volatility. Markets reward discipline. They punish emotion. Whether silver breaks 35 tomorrow or months from now, the key is understanding what that move represents in the broader macro landscape. It could signal rising inflation expectations, declining confidence in fiat currencies, expanding liquidity, and tightening supply dynamics. Or it could be a temporary surge within a larger range. Watch the levels. 30 is support. 35 is the gate. 40 is acceleration. 50 is historical memory. Each level carries implications, but none of them eliminate risk. Serious investors do not chase headlines. They analyze structure, liquidity, policy, and positioning. If silver breaks 35, it may indeed change everything, but only for those who understand why it is happening and prepare accordingly. If you want analysis grounded in macro logic rather than hype, subscribe and stay focused. The next major move will not come with warning sirens. It will come quietly through levels like these.